Hey, everybody, and welcome back to the show. I'm your host, Chase, with my co host, Rob.
Good
And
afternoon.
yeah, today we've got an interesting topic to go over. We're talking about um, college savings, and we're going to go over one specific plan that's most widely used. I know a lot of them can be state specific, but the most commonly used one we're going to touch base on and just kind of give you guys a rundown on what it looks like, and then after that we're going to kind of talk about a supplemental plan that might
Yeah,
be.
alternative
Yeah.
to that. Yep. So there's many paths to saving for college,
Yep.
right? I think we can all agree with
Tons.
that. Savings accounts, grandparents can set money aside.
The biggest thing is
There's
mutual funds,
mutual
being set
funds,
up.
those kind of things that and those can all be successful
Oh yeah,
ways to
absolutely.
plan for. They all have their complications. They all have their different tax treatments as far as that goes. But they all have different levels of freedom of how that money can work, either pre-college, post-college, didn't go to college, those kind of things
Right.
there. The big three that we typically run across are some of the state specific college plans, and we're based out of Florida here, and so there is a Florida prepaid college where you are technically paying today's college rates over a 17-18 year period, depending on, or up to that anyways, depending on
Yeah, the
how
prepaid
soon you
tuition
start
plans.
it. And when your child gets to those college years, then the money that you've put in basically covers their college path at whichever various college you basically set that up under. The We won't dig into that too much,
Yeah.
and we were more than welcome to help you on those because they're state specific and every state's a little different. We're more than happy to help guide you or
Yeah.
walk you through those if that's something you want to tease out. The two plans we're going to really discuss today, or at least the main plan that we run across more times than not, is the 529.
Yep.
The outside option there is going to be more of an alternative look, and we'll dig in on that here in a few minutes. But
It's one that you wouldn't most likely
yeah,
wouldn't expect.
it's something that's become very
Right.
popular for us over the last handful of years. I believe more and more parents are starting to use it, mostly because college is becoming, hey, not necessarily the norm anymore.
Right.
We're seeing more and more people not go to college, or they've figured out, hey, I'm not going to go into a field where college is needed, and so
Hmm.
maybe I don't utilize those dollars
Yeah,
and
that's
cents
becoming much
there.
more common.
There are some limitations there. But Chase, let's kind of dig in on the 529 to begin with, and I'm gonna let you do most of the talk, and I'm gonna do more of the question asking here
Yeah.
side of this. But why don't you kind of give the goods of the 529 or the basics of it?
Yeah.
We'll
So
talk about the goods, and then let's talk about the negatives of that,
yeah. So
and then we'll
basically,
jump into the alternative side there.
yeah. So what we'll do is I'll just go down, explain, to everybody what a 529 plan is and how it works. All right. So 529 plan is it's a tax advantage saving plan. It's designed to encourage savings for future education costs, which we just went over
Mhm.
right there. There is the two main types. There's the college saving plans, which this is more so the 529 plan. It functions like an investment account. Your earnings grow tax deferred, and withdrawals or qualified educational expenses are tax free. So they have to be qualified in order to be tax free. Now, then there's the prepaid tuition plan, which is going to be a little different for every state, but that's actually becoming less common.
Mhm.
So we're just going to kind of stick with the college savings plan because I think most people really utilize the 529 or the 529 in that
Yeah,
instance.
yeah. And a lot of that transition happened just in the last few years
Yeah.
here with some changes with the 529 plan,
Yep.
making the state specific plans a little less attractive
Hmm.
just because of the freedom of being able to use those dollars, if your child doesn't go to college,
Yeah.
so to speak. So I know the strings got a little loose a handful of years ago, maybe that 2016, 17, 18 range,
Hmm.
where some of those plans changed. But well,
Yeah,
keep giving us a
yeah,
rundown there on that. So
absolutely.
I'm sorry for interjecting.
No, you're good. This is what we do here.
Yeah.
So bringing it back to the 529 plan or the 529 plan, let's talk about the contributions and the limit. So the contribution rules. So contributions are always going to be after tax dollars. So that's not going to be tax deductible federally. Growth inside the 529 plan is tax deferred and tax free for qualified educational expenses, which I'll touch base on that once we get rolling through for what that is.
Sure.
And the thing on this is anyone can contribute to the 529 plan. Parents, grandparents, friends, or the student themselves can make contributions to the plan. The 2025 contribution limits, there's going to be no annual federal limit for the 529 plan, but contributions are considered gifts for tax purposes. The gift tax exclusion for 2025 is 18,000 per person per beneficiary. Now, for married couples, you can contribute 36,000 per beneficiary without triggering the gift tax. Now, there is another way that you can do this. Most people don't normally elect this. This is the 5-year election rule, which you can front load the account up to 90,000 or 180,000 for married couples in 1 year. So you're treating it as it's being spread over for 5 years, but you're just doing a front load. So that's kind of pretty simple for the contribution limits right there. There's not a whole lot, and it allows you to make high contributions into the account. Investment options and risk inside. So investments typically offer age-based portfolios. So basically what that means is it automatically becomes more conservative as the child starts to near college, because we don't want to stay too aggressive, because we don't want to lose what we have in there. So we want to, it's just like a time horizon, it's treating it that same way. We want to move things into a safer vehicle as we get rolling. You can do custom, static portfolios, basically mutual funds, ETFs of that nature. Risk inside is something that needs to be talked about because you are susceptible to market risk. These accounts are not safe guaranteed. They are actually involved in the market, which is something that many people need to understand. So with market risk comes value fluctuations due to market circumstances. Plan performance, each state's plan varies in fees and investment options. And then there is an overfunding risk. If the student doesn't use the funds for qualified expenses, taxes and penalties may apply. So there's going to be a 10% penalty plus taxes on something that's not a qualified expense that the funds are used for.
Just like you pulled it out of your Roth or traditional account.
Yep, exactly. Exactly. So taxation rules. So federal tax benefits is the earnings grow tax-free. Withdrawals for qualified education expenses are all going to be tax-free. Now, if you do a non-qualified withdrawal, that's going to be subject to federal income tax on earnings plus the 10% penalty. So the state recapture tax if you claim a state deduction. State benefits, over 30 states offer state income tax deductions or credits on contribution. Florida has no state income tax, so there is no deduction benefit. That's one beautiful thing about Florida. We don't have state taxes, but you don't get a certain deduction there. So qualified expenses, this is going to be the tax-free withdrawals here. So what are the qualified expenses? So the funds that are going to be used for tax-free purposes include tuition, fees, books, supplies, computers, internet access and required technology, room and board, if at least half-time student. Apprenticeship programs is something that you can now utilize. So they have to be registered.
Qualified.
That's a qualified expense.
Yeah, well, the apprenticeship has to be qualified with.
Right, it's got to be registered with the.
Correct.
Yeah. And then K through 12 tuition, but you can only do up to $10,000 per year for beneficiaries for that.
Yep.
And then you can actually utilize it for student loan repayment. So, but again, it's up to $10,000 per of lifetime per beneficiary. So there are some stipulations there, but let's get into the non-qualified expenses, which will be taxed, and penalized.
Yep.
So examples of this would be transportation costs, sports or club fees, health insurance, dorm furniture, decor, things that you want to put inside your dorm.
Don't qualify.
Don't qualify.
Sure.
Mini fridges, sorry.
I can't get the 50. Mini fridge.
Oh,
the 50. Or that 65 inch or whatever. 72-inch TV. Yeah.
I swear it's for study purposes. I can see the numbers.
It's part of my
better.
computer.
Yeah. And then, study abroad programs that are not approved by the U.S. Department of Education. So some of those can actually be utilized for qualified expense. But if it's not approved by the U.S. Department of Education, you can't. And remember, for the non-qualified expenses, it's going to be withdrawals for these are going to be taxes plus 10% penalty on the portions.
Taxes on the gains, correct?
Correct.
Okay.
Yes.
Similar to a Roth.
Yeah, similar to a Roth, exactly. Now, there are some new rules for 2024, 2025. You are now able to do a Roth IRA rollover option, which is a new rule. So unused 529 funds can be rolled over into a Roth IRA for the beneficiary, not the owner of it. So not always the owner is going to be the beneficiary.
Right.
So lifetime rollover limit is going to be $35,000 per beneficiary. So the max is only going to be $35,000 that can be rolled over. Contributions, the 529 must be at least, conditions for this or the 529 plan must be at least 15 years old in order for you to be eligible to make the Roth IRA rollover.
Okay, so say that one more time.
Yep.
Your Roth account has to be...
No. Okay. The 529 plan has to be open for at least 15 years in order to qualify for the Roth IRA rollover option.
Okay, interesting.
Yep. So contributions and earnings from the past 5 years are not eligible to be put into that. And I'll go over that a little bit more and explain what that means.
Sure.
Rollovers count towards annual Roth contribution limits. So being that how this person is not going to be 59 and or is not going to be 50 years old, $7,000 is what you can roll over into it.
Gotcha.
Hence a year. So meaning the $35,000 lifetime limit is what that would be.
Gotcha.
So the beneficiary must have earned income at least to qualify to the rollover amount. So as with any type of Roth IRA, you have to have earned income to open it. So there has to be some sort of job that the beneficiary is having, making some sort of income in order to do that. So let's kind of touch base on the advantages and limitations of the 529 before we get into
and I've got a big question if you don't cover it. So
yeah.
Yep.
All right. So advantages of the 529 plan: tax-free growth and withdrawals for education, high contribution limits, which is often greater than 300,000 total per beneficiary. Control stays with the account owner. Flexible beneficiary changes, so you can go from sibling to sibling. You can do cousins, parents,
and that's something I think changed a little bit too with the new ruling.
Yeah.
Years ago, so.
Yeah, so you're able to pass it on. So if let's say one family member, one sibling doesn't use all the funds, you can switch it over. Exactly. And then the new Roth IRA rollover provides backup use if you don't have somebody else to pass it on to. As a beneficiary that needs to use the funds for any type of college or educational. So those are the advantages. Now here's the limitations. So non-qualified withdrawals face tax plus penalty. Investment risk based on market performance, meaning that you're going to have volatility inside there and nothing is going to be guaranteed. So there is the possibility of losing money inside that. So it also may reduce financial aid eligibility.
That's a big one.
That is a big one. Yeah. Actually, speaking on of that, I actually think I might have skipped over something here with that.
We'll cover that. We'll cover that on another topic, another day. But so FAFSA, FAFSA, if I can say that correctly, is where you're doing a loan application, those kind of things for student student loans and
Right.
those kind of things, and qualifying for those type programs. The 529 can uh, be very limited, or
Yeah. So
limit
the
your
the
ability to do
the
those things as well.
529 owned by parents count as a parent asset. So up to 5.64% of value counted in the FAFSA expected family
Hmm.
contribution. And then the 529 owned by grandparents or others, there's no FAFSA impact until distributions are made.
Correct.
So at that point, distributions may count as student income.
Correct.
hmm so let's kind of get back into what it means for the Roth rollover.
Yeah.
Going to touch base on that just a little bit more on the ineligible parts of it.
Sure.
So
Can I ask one question before we dig in on that?
you just did.
Okay.
No, just kidding.
Um, one of the big things in is, what if my child does not go to college, and say, or none of my children do, right? It's something we're not going to pass down to the next beneficiary for them to use there. What happens? I've got, I've maybe been funding this thing for 15, 18, 20 years. My child says, hey, I don't want to go to college. I think I'm going to go to a trade school, or I'm just going to go jump in the workforce or military or whatever they may do. What are my options as a parent to have access to those funds, or go use those funds, or what happens, right?
So, well, now we are able to apprenticeship programs, trade schools, and things like
Mhm.
that. A lot
Yeah,
of those are now
they're
falling.
covered there,
Yeah,
and
they're
I'm more
covered there.
talking about, and I know I said that, but I'm more talking about my kids going to the military. So we're not going to use these at all,
Right.
right?
So with that, then the rollover comes into play.
Okay.
Moving that into there. Um, there's still some going to be some stipulations because once it's in the 529 plan, you don't have anywhere else to put it. The only
Yeah,
thing that you can do
but
now is the rollover, but you can take it out.
you're rolling
Unfortunately,
it
the
over
penalties.
to a Roth
Roth IRA,
account.
yeah.
Okay. So all of a sudden we're back to being limited
Yep,
access
back to
to
being
those
limited
funds. I'm like,
access.
wait, it's only
Yep.
59 and a half
hmm
to do anything. Correct.
Yep.
Okay.
Yep. It's
That
back to the
was,
limitations on
yeah.
that.
So
Yeah.
now that's monies that I had planned to use for my child's education is
hmm
now locked up for the next
Yep.
30 years or whatever it is to get me to 59, 20 years, 10 years,
Yep.
whatever. I
Exactly.
guess I'm in that phase now. So I'm like a little right around 10 years now. So
Yeah,
uh,
getting locked
to
up a
get to
little
that,
bit
but
there. Yeah.
okay. There. So, well, so you were talking about the conversion
Yeah.
piece, kind of leading into that.
Yeah, yeah.
What's
So
what?
with the Roth IRA rollover, doing that conversion, I know I said that, um, you know, within the last 5 years of funding, that portion of it is ineligible to be rolled over
Okay.
into the
So,
Roth.
I've up to the last 5 years, I've got 100 grand. The last 5 years, I've put in 25,000.
hmm
The only thing eligible to actually roll to my Roth is the $100,000.
Correct. So let's look at it this way. So say you opened up a 529 in January of 2010.
Okay.
You contributed 20,000 in 2015, 10,000 in 2022, and then another 5,000 in 2024. So you want to start funding or rolling the funds into a Roth IRA in 2025.
Because my child didn't go to college.
Right,
Okay.
exactly, sure. So eligible for rollover, the 2015 contribution and its earnings because it's more than 5 years old. Now, the 2022 and 2024 contributions and any earnings tied to those amounts still within 5 years window are not eligible.
Okay.
hmm
So that money just has to sit there till we get to the 5 year limit.
Yep.
Okay.
So you could be
So
6 years and then you could throw it on back in
okay.
there. But
So somebody like me, I'm in my late 40s. Actually, be 49 here in a month, which is hard to believe. But somebody like me, not a big deal. But maybe a parent that is older and,
yeah,
and getting closer to that retirement, those funds would be nice to have
yeah,
access to.
exactly.
That may change that ball game a little bit. Where I'm
Yeah,
having to wait or whatever there.
yeah.
So
But the
okay.
unfortunate thing is the money has to roll to the beneficiary. So it's used for them. Yeah.
So that's even bigger monkey wrench.
hmm
So now this money goes to my child
Yeah.
as a Roth.
Yep. It's
Ah,
instead of being used for their,
can you?
tuition and their education, It's going into a Roth IRA for them.
So could I make my spouse the beneficiary? Not sure. Maybe a research question. I put you on the spot there.
That could be more of a research question. I'm not
Okay.
going to say, never had a spouse question be used for that before. It's always been in the realm of the student.
So, all
Yeah.
right, well, I'll put you on the spot there with that one. I'm not sure on that answer either.
Yeah, no, that's
So
great.
that's something maybe we need to look into there.
Yeah.
That's something I'm sure we'll have to cross at some point, John, there. So,
Yeah, definitely.
yeah,
Definitely.
cool.
I like that. But as of, as of that, we'll get back to kind of me explaining this a little bit now. So, um, funds contributed and any earnings on those funds within the last 5 years cannot be rolled into the Roth IRA, which I just explained. So, why this rule exists, it's to prevent short-term parking of money in a 529 just to gain tax-free growth before moving it to a Roth. So, to ensure the rollover only applies to genuinely long-term educational savings and not as a tax shelter advantage. So how it works: when a rollover is processed, the plan administrator must track contribution dates. Any contribution made within 5 years of the rollover date, plus the earnings attached to those contributions, are ineligible for the rollover. The 5 year window applies on a rolling basis. So it's not just the first 5 years of the account's life.
Okay.
Mm-hmm.
Okay.
Yep. Yep.
Cool.
Exactly. So, just a little summary on that. So the rule is, 15-year account, 529 must be open for at least 15 years, ensures long-term savings. The 5 year look back is the contributions and their earnings within the last 5 years you can't roll. It prevents short-term tax arbitrage. So lifetime limit is going to be 35,000 max per beneficiary. So back to your question on that, you could roll over a portion of it and then change the beneficiary. So you might work out that way.
Okay.
But there are caps to rollover benefits. And then the annual Roth limit must follow annual Roth contribution caps, which if you're under 50, it's 7,000 in 2025. So it prevents front loading.
That's right.
Mm-hmm. So that's pretty much the 529 plan wrapped up in a nutshell.
Yep. So overall story there is a lot of handcuffing if those funds are not used for college purposes for your child there, right?
Yep.
So Chase, we've gone through 529 plans with our clients multiple times. I've run across dozens of them through the years. Florida prepay was very popular up until about 5 or 6 years ago, and so I saw a lot of that along the way as well. But one of the big alternatives that we've started using here in the last, I won't say recent years, I've been doing it really since getting into this field years and years ago. Somebody showed me this concept and I was like, that is
brilliant.
Yeah. I mean, that's a great term for it.
It's really an eye opening to the differences.
Yeah. And, it's, it allows a lot more freedom with this plan to use those funds not only for college but really anything, right? So what we're talking about using here is life insurance.
Yeah.
And so in the cash value within those life policies, we use what we call kind of investment grade type policies. One of the more popular ones here in the last 10 or 12 years is what we call an IUL, an indexed universal life.
Right.
Whole life is still a great option to use for this. Some of that can get very company specific, depending on the terms and what the guarantees are inside those policies as far as dividends and those kind of things go. So we want to be got to be a little more careful with that. We'll say a little more. I mean, you need to have a lot of due diligence around the specific plan that works for your client. But there are some more limitations there, I would say, on that end than some utilizing the IUL piece from company to company. But using the index universal life, and if you're not familiar with the index piece of this, that index universal life it still has that market play to it, or that market feel as far as how the money grows inside the policy. So there's typically less guarantee returns inside these plans, but you have a lot more upside ability over a fixed 2, 3, 4% return plus a dividend that the whole life is. Um, cost can be a little less inside of those, especially on the insurance rates. Those are typically a little cheaper than whole life there. Again, that's company to company on what that may or may not look like there. And then, the freedom there. The index, let me go back to this. The index piece of that is because the growth inside these policies is tied to an index of some kind.
Right.
That an index being the S&P 500 index, Dow Jones Industrial Index, NASDAQ index, Barclays. There's Morgan Stanley's. There's tons of indexes out
Yep.
there. Some of those are hybrids of different indexes as well that your money gets plugged into. Right, you're not
Mm-hmm.
necessarily bought into that, but your growth is dependent on the growth of that index.
Right.
What we have to be careful about is some of those indexes, and this is another company to company specific thing, is there are caps and participation rates on those. So that's something you need to discuss with your life insurance agent or advisor, whoever's working with you on these type plans. But the good side of that is the fixed part of that,
Right.
fixed indexed, right?
Mm-hmm.
The fixed part of that is that it has a fixed floor of 0. So once your money goes in, your growth inside those policies has a 0% floor, meaning that we don't lose money on the investment component,
Right.
right? Now you will get, if your money isn't gaining, you will see expenses come out of that,
Mm-hmm.
right? So we still got a cost of
But
insurance,
that's not tied to market loss.
but that's not tied to market loss itself. So and it's really just dependent on the funding and how that's being covered as
Right.
well. Then, so those that's kind of the basics of it. So we open up a life insurance policy on the child, right, assuming they're insurable. Once that's open, then we decide how much we're going to put into that. And a lot of times, I'll run a 529 plan next to the life policy, right? And I show them the differences there
Mm-hmm.
and what they're getting for that, right? And that's what we kind of start with, right? Just like you said, typically we're being a little more conservative with these 529 plans because of what? We want to make sure that money's there when we
Yep.
need it at college age, right? So we still have that risk adjustment over time. In these plans, we don't necessarily have the
You don't have
risk
to worry about
adjustment.
that really.
We're plugging and playing, and we're just hoping
Mm-hmm.
these cap rates are up or down. They're going to ebb and flow, so we're just kind of watching those,
Mm-hmm.
and then we're watching the participation rates. So we're just moving from different indexes, and that should be an annual thing you're working on with your clients, anyways, on how that money works there with that. Um, some of the goods. So compare contrast here a little bit. Some of the goods with this. Let me go back. The cash value that we're working with, we're building this money inside of that, is what we're going to utilize for those college years. So we start putting money in young when they're small. The money grows over 18, 19 years, whatever, we get to that college age. Then we need money to go to college,
Yep.
right? To fund tuition, these kind of things. So then we've got multiple ways to get the money out. One, we can surrender the money out, we can take it out, use it, not worry about it. We can borrow against that money, so we can actually take a loan against it.
Mm-hmm.
We can use those funds, there, and then the loaning can be different from
Yeah.
company to company. Some companies offer fixed and variable loans. Some offer participating loans, which is another. I'm not going to dig in on that, but pretty powerful concept there on how that money works. So you actually borrow your money out, but your account balance looks like your money's still in there. So as your creditings are coming in, it's on
It
a
bounces
much
right back.
bigger
Yeah.
amount than what it would be if your money wasn't there
Mm-hmm.
along the way. And the thought concept there is I just became my own bank. So I didn't
Right.
have to go to the bank or borrow a federal loan or
Call
whatever it
that
is.
infinite banking.
Infinite banking. So you can look that term up as well. So now I'm loaning money and I'm paying myself back,
Mm-hmm.
right? And so it's there's a lot of leverage there with that. Some of the goods. Number one, and I will argue this till I'm blue in the face. There is no better gift that you can give to your child than a life insurance policy. It guarantees their insurability for as long as they have that policy. These are permanent policies.
Right.
So an IUL or a whole life is a permanent policy as long as the funding is kept in place. So your child's 1 or 2 years old when you start this plan. he's guaranteed insurability or she's guaranteed insurability for their entire life as long as that plan is being funded appropriately. I don't think that's a gift that you'll ever regret giving your child. Specific point here, I've actually got a client or a friend of ours. Their child got a life. They did the right thing. They got them a life insurance policy when they were young. Had that policy. They worked with an agent. He told them, "We're going to go get your child approved. You can go ahead and cancel that plan." They canceled it. They got a new went to get a new policy. Something came up on the blood work. Not good, right? Child had a rare blood disease, and unfortunately, they had already canceled the other policy and they weren't eligible for the new policy. So always be careful with that. Maybe a little deep dive on this conversation there, but never give up what you got till you got the
Right.
other in place, right? Don't
Right.
start a new job without,
Having
don't quit
another
your
one.
new
Yeah.
job until you got or quit your old job till you got the new job, right? Same kind of concept there with life policies as well. So that's my red flag there, my soapbox I'll stand on. But no greater gift you can give your child than that. It guarantees their insurability for their life, right? No matter what happens to them along the way. So now, a lot of plans we use today have living benefits. So in the event they were to get some type of cancer, heart attack, stroke along the way, those living benefits kick in. So instead of you guys having to pour money out of your personal pockets or worry about the insurance, your health insurance component, we got money there to kind of take care of those things because those can be used. And it comes out of the death benefit, right? So it doesn't even go against the cash pot side of the policy. Um, we're falling under contract law. So, we mentioned that 529 plans legislatively have changed over the last 5, 6, 7 years. There was one ruling that just changed here in the last 2 years that you mentioned. Not so much in the life side of things, because those fall under contract law because it's a contract with a specific company. We fall under a different set of rules. So Congress can't come in and change the rules on us and whip the wool out from under us, so to speak, there along the way. So that's a good thing. There's no limitations on funding. So even though Ross have high limitations there now, not used not be quite as good there. The same thing on this side. There really is no limitations. If we can get the insurability side of it, we can fund it how we want to there. Right. So there's a lot of paths to get around some of those limitations when maybe insurability, the value of your life. I'll say my kids are invaluable. There's no death benefit amount that would go against them, but I also have to be realistic and say they're, they maybe are not worth $50 million. All right, either. So we've got to be careful with that part of it, but typically something we can get around there, working specifically with a company and understanding how the money's going to be funded there too. Big one here. This is probably the biggest thing. There is no restrictions on how that money's used. Right? I don't have to use those for school purposes.
So, but let me ask one thing. So, what's the taxation on that?
That would be zero. Right.
So it's all tax free.
Depending on how that money is pulled out, there could be taxes on that money in a surrendering situation where we're surrendering dollars out.
But we don't want to do that.
But that's typically not what we're trying to do there, right? So most of the time, I'll say 99% of the time, those dollars and cents being pulled and used for college education will be considered tax-free for those purposes there. Doesn't matter if I've got cash value built in that policy. They're depending on what's available to borrow against, you can go use that money for whatever you need to, or
down payment on a house,
payment on a house,
car,
that furniture you mentioned for the dorm room.
Hey, you got to get that mini fridge, right?
Got to get the mini fridge, right? So there is no limitations there. What if my child doesn't go to college? Hey, Dad, college isn't for me, right? What happens? Well, I don't have to roll my money over to a Roth for my child, right? Those funds can be used for whatever, right? I've had parents that this has happened to, and maybe the parents have put $40,000 or $50,000 in. The account balance was $80,000, $90,000, $100,000 over that time frame, and child said, "Hey, I don't want to go to college." All right. Well, Dad's like, "Well, hey, look, that's fine, but I want to help you. Still want to help you out in life, right?" So what I'm going to do is I'm going to give you this policy, let you have it. I'm just going to keep my money, right? So we go in, we do a withdrawal out of the money that he invested, the dad or mom and dad had invested, and dad's made whole again. Now he lost interest on 50 grand over the X amount of years, but again, that's parent to parent on how they want to mitigate that. But all of a sudden they got a $50,000 bump back in their savings account, and the child's got 20, 30, $40,000 to go start their life with, right? Down payment on houses, build from, right? They've got an instant retirement plan put in place. So all of a sudden we can take these plans and transition them out of college planning and into retirement planning, right? Absolutely. And it just flows right over to what we call a tax-free retirement account, TEFRA. So, or LIRP, life insurance retirement plan. So, a couple of kind of industry standard common sayings there. So there's a lot more flexibility with these plans as far as those kind of things go.
But also, you're knocking things. From what it sounds like, there's more things you're checking off in a box. So, of course, it's life insurance. So you have a death benefit if the unfortunate happens.
Living benefits.
You got living benefits
covers your cancer plan, heart attack plan, stroke plan for you, the life of the child.
Nothing there doesn't have to be a qualified expense in order to pull out the cash value. Correct. So you can take a loan out of that tax free and use it for anything that you need to. That mini fridge.
And let me say this too: the loan rates inside these policies have been, at least the ones I've been using, have been drastically lower than what the bank's loan rates are. Right. So you're going to go borrow to go buy your child's first car, right? Maybe this is one of the deals where you've planned, hey, I'm going to go buy a car, and we're going to put extra money away on top of the college plan, right?
And the longer you're inside that policy, the rates change.
Well, and what have car rates been over the last handful of years? High fours into the fives, right? Well, we don't. Inside of here, we've got fixed rates at 1% and 2%. If I've got a couple of companies. If you've had the policy for 5 years, it's actually 0%.
That's what I'm saying.
Right?
Exactly.
So the net zero. So you're actually borrowing at 2.5, but they're paying you 2.5 on the back end. So all of a sudden, it's an even wash, right? So there's a lot of ways you can utilize these policies through time. You mentioned infinite banking earlier. What a concept, right? Nelson Nash, go look this up. Becoming Your Own Bank. Great book. I encourage everybody to read it if you haven't already. It's a great book. It has a lot of great information in there on utilizing these policies, not necessarily for college planning, but for businesses and those kind of things too.
Utilizing that cash value and letting it be perpetual.
Yep. So, well, I know we're running out of time, but trying to keep these under an hour here, and maybe trying to even keep them under 45. We get talking. I know.
So give us a little forgiveness.
Yeah.
We want to give it all to you.
One of the negatives or I'll go through a couple of negatives. Negatives are one, we got to get qualified for life insurance, right? So sometimes that can be a challenge. Most insurance providers will write policies on children like 30 days now, right? So if your child's been around for 30 days.
So actually, personal experience, just had a child and I've already started getting him set up.
Yeah. So yeah, just here in the last 30 days.
He's got his social security number. He's ready to roll.
There you go. So 30 days is typically, or 15 to 30 days. I'll say some companies even go 15 days. You get qualified to do that. So that can be a thing. A lot of these policies come with surrender charges, and typically those are going to be 7 to 10 years. Some run them out a little longer. I don't typically use those companies for these scenarios here because we're going to need those funds a little quicker, right? So, and what I mean by that is your cash value may be $20,000, but and you're in year 5 of the policy, but your surrender value is actually only 10 or 15, right? What that means is I can only borrow up to the 15, right? So not a big deal usually, but that can be something we got to consider there, especially if we start later in the child's life and they're up in the 8, 9, 10, 12 range. Another negative there, right? The older the child's get, the more money we're going to have to put in to do the catch-up pieces, right? You would have to do that in a 529 plan as well. So, maybe not a big deal. But earlier you can start these, the better.
Right.
I typically like to get these rolling before age 5.
Yeah.
So there one benefit, insurance is very cheap on a child, right?
Yes.
So these early years when they're young, these rates are very, 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 very positive there for the child's cost of insurance. Their piece of it, at least there. So other negatives, depending on what company you go with, there are other fees involved with this.
Of course.
With IUL specifically, also.
But the
Um,
fees inside that will still be less than the whole life.
Oh, absolutely. So, bounce that against the whole life. Your whole life typically expensive. You're paying for the word whole in that, WHOLE, typically there. So,
And flexible premiums too for IUL.
another one. So, I forgot about that. So, great point there. Your premiums are flexible with IULs, right?
Mhm.
So, we do have minimums that we have to keep up with. But hey, grandmom, grandfather gave us some money for birthday or whatever. Can we put this in our policy? Yes,
Mhm.
you can, right? Above and beyond what I'm already paying in?
Yeah.
Absolutely, right? That's the stuff we want to build it around. So, a lot of that, there can be restrictions there. So, we have to build the policy with those thoughts in mind
Yeah.
early, right? So, typically when we're building these, we want to build them as a what we call a minimum non-neg,
Yep.
right?
Mhm.
Minimum amount of insurance to maximum amount of money we're putting in or growth along the way. But we don't want to create what we call a MEC, a modified endowment contract. When we create a modified endowment contract, we lose a lot of the tax freedoms there that we would keep with a non-MECT policy.
Yeah.
So we just want to be careful of that. That's something you need to discuss with your insurance agent. And as you're funding this in the grandmom and grandpa type situations with the bonuses at work, or hey, we've got an extra $1,000 to throw at this
You got to make
year.
sure that it doesn't
We,
push it over.
right, we've got those limitations. So yes, we can build these with these big caps of money. We put as much money as we want to put in, so to speak, but we just don't want to go over those cap limits that
Yeah.
we've set up there with that. Um, Other negative, I mentioned this earlier, there can be caps on these index options and participation rates. So caps work like this. Most of these that I'm seeing right now are somewhere between 10 and 12% caps. On the S&P 500? What that means is if the S&P were to do 15%, you're only going to get up to the 10 or whatever the
Yeah.
cap limit is, right? Those caps are going to ebb and flow though. Sometimes I've seen caps up at 14, 15%. I've seen caps go down to 7 and 8%,
Yeah.
right? Just depending on where the market is. When the market's down, the caps are going to be down. When the market's up, those caps are going to typically be up.
Mhm.
Participation rates work a little differently. Similar to a cap, they've got their limitations, but let's say you're in the S&P and it's got a 70% cap on it. Well, if that S&P does 10%, you're only going to get 7% on that. So you're just taking whatever it gets, and you're going to take the cap on that at 70% there. Um, Funding can be different as well. If you're doing month to month funding, you kind of get that dollar cost averaging concept in there when you do that. Your points to points. These are the funding. The interest creditings only come in once a year every time money goes into the account. So your S&P's at 6,500 points today. Next year it's at 7,500 points. Well, that was 1,000 point growth. 1,000 divided by the 6,500 is going to give me my interest rate that I could have made. Now I'm up to my cap limit or my participation limit, depending on what that may or may not be. So that's the basics of the math there to kind of run through. So that's that there.
Yeah.
Okay. I'm trying to think of some other negatives. I mean, there's not.
There's not, to be quite honest, there's really not a whole lot of negatives that come into this.
Yeah, yeah.
I think one of the major negatives is if you start funding it later in life, then it gets a little more costly.
Right.
But the advantages are still going to be worth it.
That's right. This
Now,
same concept too can be used. We use this not only for college planning. Usually, when I show this to the parents for college planning, they're like, "Well, can I get one?"
yeah,
Right?
yeah,
Yes, you can. right? And it just depends on where you're at in life, if it makes
So
sense as far as funding and
this is
what we're
actually a
doing for
great
planning.
place. So for those individuals that are, make $253,000, you actually phase out of the Roth. You cannot contribute to
That's
the Roth.
correct.
So, and here's the beautiful thing: this you can use in place of that. Now you can access that money before 59 and a half.
Hmm.
You can use that as infinite banking. You can get tax-free loans from yourself, pay yourself
Yep.
back. So keep that in mind also. This isn't just a play for your kids, which is a
The,
phenomenal play. I
this
chose
is
this
the
over the
secret of the wealthy
yeah,
right here.
yeah. This
So
is this
when
is
when you
this is
hear,
what the government doesn't want you to use.
yes, they don't want you to know,
Yeah.
as well. Yes. So this is one of those secrets of the wealthy that we've come to figure out there. Wealthy individuals, this creates the generational wealth.
Yeah.
When you're making north of 300K or so as a couple, 170,000, 80,000, I think, on the individual side, you start phasing out of the ability to put money into your Roth.
Right.
Where do we go? Well, we can utilize these plans to dump the money into. Typically, because you're older, the death benefit's going to be a lot more, right? And so, cost of insurance and those things start playing a little bit of a factor there. So we've got to be careful with that. We still use that same minimum non-MEC, what we call min-max non-MEC, minimum amount of insurance, maximum amount of funding. Keep it a non-MEC.
Allows that cash value to
That's right.
grow.
Cash value to grow. Then we turn around and we use those funds over our life, either for retirement income, supplemental income along the way. We borrow against it.
Yep.
So you borrow. Here's a concept: you borrow your money out, right? It's a participating loan. So we got $500,000 built in here. We borrow 100 out. I go take that 100 and do an investment over here, but my crediting keeps coming in. Well, I got a participating loan, so it still looks like my 500,000 is in my account,
Yep.
even though I've only got 400,000 of real money there. My crediting's come in on the full 500,
So you're getting
right?
more into it.
So now I'm making money over here. I'm making money on my investment over there, and I'm paying myself back a loan of some kind, right?
Yeah.
So it can be a very incredible thing, not only for college planning, but for retirement planning, life planning, investment planning, estate planning. But then on the back end of that, if we set and structure this thing up, especially in the retirement income space, this is where the generational wealth piece comes in for a lot of our clients. It's where they pass down the millions of dollars, the $1 million life death benefit, right? Tax free to their children.
Yeah, this is how
And so
the wealthy stay wealthy.
the wealthy stay wealthy
Generational.
is that this way here.
So that's
So
a whole lot of great information there. Now, why don't we just do a rundown, a little bit of comparison on the two. So
yep,
529. Let's look at the contributions. So on a yearly basis, it's 35,000, or excuse me, 36,000 for married couples, 18,000
for an
for non.
individual.
Yep. Anybody can contribute to that. Parents, grandparents,
Mm-hmm.
friends, the student.
Right.
So
Yep.
that's
On this side, no limitations. We
yep.
can fund it how we want to, as long as we set it up that way. It's got to be set up appropriately.
Yeah,
So
absolutely.
you got to spend some time there doing that. We set it appropriate. Doesn't matter who pays the premium in or pays the dollar amount in. That no limitations there as well.
Yeah. Okay. So now let's look at taxation. What are some with the 529 plan, you have to have qualified expenses for the investments inside to be taken tax free. So that's
Yep.
tuition, books, room and board, all those instances that are for school purposes. That's all tax free. But let's say you need something that's outside of it. That's going to be tax plus penalty, so you're paying more.
That's right.
And now with the IUL,
Doesn't matter what I use my money on. I have no restrictions. We can go use the money for whatever. There are no taxes. There are no penalties, depending how we structure that money coming out.
Right.
There could be some tax on some of that money if we were surrendering money out, and that's just something, time and place and where you're at there. And really, here's the tax piece. If you've put 50,000 in and there's $60,000 balance, and you decide you want to pull that money out, then or pull all of it out, then you are going to owe taxes on a portion of that 10,000 there.
Yeah.
Okay,
Right.
so that's where the tax piece. But if as long as we're either under that
Hmm.
or we're pulling that money out through a loan of some kind,
Right.
sometimes a 0% loan, sometimes a 1 or 2% loan, sometimes a 3 or 4 or 5% loan, depending on variable versus fixed and where you're at in the company and contract in place. There are no taxes on any of that money.
Right. All right. So let's talk about risk. So within a 529 plan or 529 plan, you are within the market. You are invested in the market, whether
Mhm.
it be mutual funds, ETFs, individual stocks. You are susceptible to market risk, meaning that money is not safe. It's not guaranteed. So that's one thing
Yep.
that you have to keep an eye out for in those investments, especially as age related, funding gets into it. So let's say that the closer you get for your child to go to college, you need to draw back on the
Risk
investments.
adversity.
Exactly.
Yep.
So we don't want to lose what we put into it
That's
thus
right.
far.
On the IUL side or even the whole life side, we don't necessarily worry about that because we've got that 0% floor. The only big thing we need to pay attention to are our cap rates and what indexes we're in based on what we're seeing there, right? So we can go make as much money as we want to the limitation
Yeah.
pieces there, but I don't have that risk factor that I'm having to worry with the ebb and flow back and forth on that.
And then speaking of, the investments side within the 529 is, like I said, mutual funds, ETFs, etc. But again, most of those are going to be, on in certain indexes, the S&P 500. A lot of those companies are going to be within that, Nasdaq, Russell 2000,
Yep.
Dow Jones, etc.
Yep.
But the you are limited on the investment changes per year. You can only make two investment changes twice annually.
Yep.
Hmm.
On the IUL side, kind of similar, but you can only make investment changes typically once a year or every other year, depending on the crediting strategies
Yeah.
that you've got placed in there. So
There's 1 year point
that
to
is,
point, 3 year point to
yeah,
point,
one,
things like
two,
that.
three. On those point to point crediting years, those are when you'll get to make those adjustments here.
Right.
I got another one for you. So, yes, life insurance expenses, right? So, there are expense components on the life insurance side that can be hindrance to things if you're not funding the contract appropriately or that were to stop or whatever along the way. On the flip side of that, what are your fees, right? On
Yeah.
that side, right?
Yeah. For
529, right?
yeah.
We got investment fees,
Yeah.
you've got
Well,
advisory
yeah.
fees,
If you're
right?
not managing it yourself, you have investment fees, you have advisory fees. It all.
Expense ratios,
Yeah.
all that stuff
Exactly.
adds up.
It all
So,
comes down into that.
so there's still cost on both sides there, right?
Hmm.
Okay,
Yeah, definitely a cost. And one of the biggest things here that could be most costly, it's not for non-educational expenses.
right.
The 529
And
plan
then over here, we can use that money for
for
whatever,
anything.
right? So,
Mhm.
car, transportation, the fridge,
Helping your kid get
big
ahead in life.
the big screen,
Yeah,
TV,
gotta get that mini
or
fridge.
whatever there. So, a lot of things there that on the back and forth. But well, we're way out of time now.
Sorry, guys.
So
We get on a
so
deep dive, go down a
yeah,
rabbit hole with these.
we do.
Bear with us. We're working on summing things up a little bit better,
Yeah, we
but
get into these things. We're like, all right, we're gonna make this. Literally, we said this would be a 20-minute thing. Here we are, 40 minutes, 50 minutes
if
into
you
the
can't tell, we
program.
enjoy doing
Yeah.
this.
So, but if you think one of these plans is the right mix for you or something you guys want to explore, we encourage you to reach out to us.
Yeah, absolutely. Please.
Uh, more than happy to dig in with you guys. Again, both of these plans, there's considerable amount of time and different things that you want to consider.
Yeah.
Um, the IUL play or the whole life play, the life insurance play is not for everybody.
Yeah.
It is just not. And so don't think it is, but
It's always good to have the options
it
presented
is.
to you so you can make
That's
you
right.
see
It's
what's
all
going to be the
about
best decision for you.
educating. It's all about educating the client, letting them make their own decision on what the best path is there for them
Right.
along the way. We will help you with those conversations. If you're already speaking with an agent or an advisor with one of these two plans and you want a second opinion there, we're more than happy to walk you through that.
Yeah.
Also give you some alternatives maybe along the way with that, but it's it really just comes down to what your overall long-term goals are
Yeah.
with this, and understanding the rules of the road, right?
Yeah, and
So,
just like I said, from personal experience, getting back to setting up tuitions and expenses in the future and funds for the future for your kids. I opted not to do the 529 plan because the IUL was a much better option, in my opinion,
mhm,
for growth down the road and being able to not have, certain handcuffs
mhm.
or limitations that I can use
Yep.
for that.
And I'll give you a good example here with myself. So I've got these type plans. I used whole life. IULs weren't really a big thing back when I set these up for my children 18 years ago now. But my oldest one is in college. He's in his first semester, and we've got this nice whole life policy out there. I've got quite a bit of cash value. I won't say it was enough to get him through college, but we've got some other things going on there along the way. But um, he got a scholarship.
Yeah.
He's got a baseball scholarship. He got some academic scholarships that is basically covering his tuition for us right now. So
That's
we're
nice.
not having to pay anything, which is pretty awesome.
Yes.
For me, anyways. I feel like I was expecting a pay decrease, and my pay stayed the same. Thank goodness. But
Little things in life.
little things in life, man, these days. But it's pretty cool that money's just kind of sitting there, still growing, still earning, and
When he
when
gets out of college and he doesn't, and
we yeah we do yeah we do need it or whatever.
yeah,
That is something I get to hand him. Son, here's something we put in place 17 years ago. He's 18 now. Did it when he's about a year old. 17 years ago, I put this in place for you. I don't want you to ever get rid of it.
yeah,
Okay. Or if you do, go take the cash and let's put it somewhere else. But there's about $35,000 in there as it sits today, off of a one-time $5,000 deposit.
yep.
Pretty good, right?
Pretty
17 years,
solid.
nothing crazy. 130, $40,000 death benefit. So, it's nothing big there, but, man, it's still a blessing, right?
Oh,
Hey son, here's 30 something $1,000 for you to go, it's yours.
yeah,
I encourage you to keep it. Thank you for going to college and doing great things and being the kid you are. But here's your reward for some of that, right?
yeah.
Use it on the house, whatever.
Like there's
Uh,
so many options
hmm,
that you can do with this life insurance piece,
absolutely. Right.
and
So,
so it's
and I think we maybe look at these in a retirement planning standpoint next time,
yeah,
or on a
oh yeah,
future episode
absolutely.
of this.
I know we talked about phasing out the Roth and utilizing this,
Hmm. But we
but
don't have to we don't have to
we'll
make 300K to go do that,
yeah,
right? We
yeah.
can implement these plans at any income level for the most
Oh
part
yeah,
and make them
absolutely.
work. So,
But for this one right here, we just wanted to break down the
mhm.
difference in, one of the major college savings, tuition plans versus, what a lot of time is kind of overlooked by people because they're not sure about it because they hear life insurance and they're just like, oh, it's
Turns them
life
off.
insurance,
Yeah.
death
So,
benefit. What do I need
but
that
again,
for?
just comes down to educating,
Right?
right?
Yeah.
Show you how it works. You got to understand the rules of the road. It's a long-term commitment in both of these. The funding options are very um, flexible, really in both of them, but can be very flexible on this side too, as well. And can be do great. Both of them
Yeah.
end up
Be
in
really great.
great put you in great places there. Just
Mm-hmm.
long term is the big thing there
Yeah.
and understanding.
Yeah.
So,
Absolutely.
anyways.
But I think we've kind of touched on
Yeah,
everything
yeah,
that we needed to, and we'll get some more of that coming at you on the retirement
yeah,
standpoint, so how you can utilize it as a financial tool as
yeah.
well. But just for the
You know,
most part, if you guys have questions regarding the 529 plan or an IUL and getting them set up for your kids, give us a call. Book an appointment with us, and we'll be happy to go over the options and what it looks like for you, and giving you the education that you need to make the best decision for you and your family.
that's correct.
Yeah.
So, well,
Well, guys,
another good one.
solid.
So,
So
yeah,
again, apologize on the on the length of
yeah,
it.
yeah.
We're working with it.
So
We just like doing this.
we're gonna try to narrow these down, maybe one day. So, but yeah, but we appreciate y'all paying attention to us here.
Yeah.
Again, Chase said if you reach out to us directly, get with your HR department,
Yep.
your RPC. If you're with RPC, get with your RPC representative with your company. they can get in contact with us, put us in touch with you as well.
If you have the LearnLux portal, get in there
LearnLux.
and book an appointment with
Yep,
us.
yep. We're both should be listed, or one of us should be listed there as well.
Either
And
way, you'll get both of us.
yep, and we're happy to work with you and talk through any of these concepts with you also.
Yeah,
So,
absolutely. So,
all
hey,
right.
just want to say thanks for tuning in. Until next time, we'll have some good stuff for you.
Yep.
But until then, hey, stay
Stay
strategic.
strategic.